We said that responsibility accounting was a system of evaluating responsibility centers. There are four responsibility centers, and for the first three, that is the cost center, revenue center, and profit center, we evaluate their performance by preparing performance reports. When we prepare these performance reports, what you're doing is comparing the actual revenues and expenses to budgeted figures. Remember the budgeted figures you would have prepared when you came up with your master budget at the beginning of the year. Once you compare your actual revenues and expenses to budgeted figure, we calculate what we call a variance. The variance is just the difference between the actual and the budget. You could end up with a favorable variance or an unfavorable variance. A favorable variance causes operating income to be higher than budgeted, and an unfavorable variance causes operating income to be lower than budgeted. As we work examples, you will easily figure out which one's a favorable variance and which one is an unfavorable variance. When evaluating responsibility centers, managers use a technique called management by exception. Management by exception is a method where you only look at large variances. So a company will set aside a figure that they say we're going to only investigate variances that are over 5%. And you would investigate those variances that are more than 5%. You need to keep in mind that they will investigate favorable variances as well as unfavorable variances that are over the 5% threshold. So let's go ahead and prepare a performance report. What you see before you is an incomplete performance report. What we have to do is complete it. Typically in your exam questions and your in-class assignments, the numbers they give you would be the actual amounts that are here and the budgeted figures that are here. You will be required to calculate your variance, let them know if it's a favorable or an unfavorable variance, and also typically calculate a variance percentage. Let's go ahead and first calculate the variance. The variance for the sales is $1,500. The variance is difference between the actual and the budgeted. The budgeted is 14,000, actual 12,500. 14,000 minus 12,500 is 1,500. You're going to put whether it's a favorable variance or unfavorable variance in the other column. Now, how do you figure out if it's favorable or unfavorable? You can use a definition or you can just analyze it. This is a sales revenue. You expected your sales revenue to be 14,000, but you came up way short. You came up $1,500 short. So this is an unfavorable situation for sales. It's an unfavorable variance. You can also use your definition to come up with this unfavorable, whether if it's unfavorable or favorable. The definition for favorable says that an unfavorable variance causes operating income to be lower than budgeted. So here you do see that operating income is lower than budgeted and it's because of a result of sales, so it's an unfavorable. It's a lot easier to look at each individual line item and make the decision rather than translate that to operating income. Next, we have to calculate the variance percentage for sales. The way you calculate variance percentage is you take your variance, which is 1,500, and you divide that by your budgeted sales. So you divide your 1,500 by 14,000, it will give you 11%. Always you take your variance divided by the budgeted amount, that is your variance percentage. Next, let's calculate the variable expense variance. Your budgeted amount was 4,000, your actual amount was 4,550. So there's a variance of 550. Whenever you calculate your variances, do not put negative numbers there. Your negative would be shown by unfavorable or favorable. You are not going to put negatives, it's just going to be a number. So you'll have 1,500 is your variance. It was unfavorable. Next variance for variable expenses was 550. Now you're going to figure out whether that was a favorable or unfavorable variance. Now let's take a look at what that item is. It's a variable expense. An expense means money is going out. You're expecting to spend a certain amount. You expected to spend $4,000, How much do you actually spend? 4,550. So you spent more than you should. Therefore, that was an unfavorable situation. So you would cause that, so that 550 is an unfavorable variance. Now let's calculate the variance percentage. Again, the variance percentage is your variance divided by your budgeted amount, and that would be a percentage. So that would be 14%. Now let's move on to the fixed expenses. The difference between budgeted and actual for fixed is $500. Again, you do not put a negative sign next to it, you just put the 500, and then now we got to figure out is it favorable or unfavorable. It's a fixed expense, so money going out, think of it that way. We expected to spend 5,500, but we actually spent 5,000. We spent $500 lower than we should have. So now that is a favorable variance. Let's calculate our variance percentage. You take your 500 and you divide that by your budgeted amount, and it will give you a 9%. Now let's take your operating income. Your operating income variance is 1,550, and let's see if it's a favorable or an unfavorable. Operating income is profit. You expected operating income to be 4,500, but it was a lot lower, $1,550 lower, so that is an unfavorable variance. What is the variance as a percentage? We take our variance, divide that by budget, and we get 34%. Whenever we are using a management by exception technique, we said we would investigate variances over a certain dollar amount. So let's say that this company had a policy. They were going to investigate variances that were over 12%. So your threshold is 12%. You are going to investigate any variance over 12%. Which of these numbers would you investigate? Would you investigate sales? No, because sales has 11%, which is below your threshold of 12. How about variable expenses? Yes, that you would want to investigate because that is above our threshold of 12%. Fixed expenses came out at 9%, and we would not investigate that. So whenever you're doing management by exception, you only investigate variances that are large, and large is measured by a threshold. Whenever you're looking organization-wide performance reports for each level of the management flow up. What does that mean? It means, for example, let's say that you have let's say Walmart has a manager over the store. So the Louisville Walmart, there'll be a manager over that store. His performance report will be only the store's performance. He reports to the manager of the North Texas division. The North Texas division's manager's report will have that Louisville store manager's reports plus all the other stores under him. Now, if the North Texas manager reports up to the Southwest region manager, the Southwest region's manager's reports will consist of the North Texas manager's reports plus all the other regions under him. So the performance levels flow up through the organization chain. Also, you need to keep in mind whenever you're evaluating performance reports, you need to keep in mind some of the variances may be controllable and some variances may be uncontrollable. Each manager only should be evaluated on controllable variances. If they have no control of their variances, it's unfair to hold them accountable for it. For example, over the last few years, we've been experiencing recessionary conditions, and as a result, sales of all companies have gone down. So if you hold your sales manager responsible for those economic conditions, that would not be fair or effective evaluation. Remember, we only use performance report to evaluate a cost center, a profit center, and a revenue center. Next, let's talk about how to evaluate an investment center.